Hi there, I'm Suro Ghatak, Director of Investment Management at the Noble Group. Today, I want to address the recent market volatility, explain what's been causing this volatility, and provide some insights as to what we can expect for investments, both near-term and long-term. After the presidential elections in November, the markets rallied almost 8% as measured by the S&P 500. But since February 19th, they have given up some ground and are down just over 8% as of Monday, March 10th. The widely owned and much revered Mag 7 stocks are down over 20%. The bond markets, as measured by the Bloomberg Aggregate Bond Index, are up around 2% for the same period. What's behind this market volatility? Primarily, investor concerns about the fallout from the brewing tariff battles as the administration levels its sights on Canada, Mexico, and China. Investors are concerned that the tariffs will lead to a trade war and lead to a recession. Let's look at the issue of tariffs and provide you some context. First of all, it is my assessment that the primary reason behind the proposed tariffs is to enact policy change from U.S.'s trading partners. In the case of Canada and Mexico, the primary ask from the United States is better border controls to control the flow of narcotics and unchecked illegal immigration. Both are relatively easy to deliver once national pride ceases to be a roadblock. In the case of China, there is an element of punitive intentions because China, the neo-colonist, has shown wanton disregard for intellectual property rights, human rights, and fair trade practices. The U.S. has the economic upper hand here because the U.S. only exports 1.8% of its GDP to Canada and Mexico. Mexico, on the other hand, exports 19.5% of its GDP, and Canada exports 25.3% of its GDP to the United States. Exports to China account for less than 1% of U.S. GDP. But China's exports to the U.S. account for 3.5% of their GDP. Admittedly, some industries will be impacted more than others. The automotive industry's supply chains rely heavily on Mexico and Canada. The bulk of our exports to China are soybeans and pork. The farmers in Iowa, Nebraska, and the Dakotas are watching nervously. Canada provides electric power to many states in the Northeast United States. Let's step back from all the negative sentiment and take a look at the key things that have driven the market over the long run: earnings growth and valuations. The S&P 500 is trading at about 20 times earnings, a number that is certainly not cheap in absolute terms compared to the long-term average of 17 times. But take away the impact of the Mag 7 stocks, the market is a more reasonable level of 18 times earnings. The key takeaway is that the markets are not overpriced, nor are they cheap. High valuations were behind the market corrections of 2000 and more recently 2022. That is not the case currently. Valuations on the Mag 7 were wildly out of hand, with Nvidia at 45 times and Tesla at a nosebleed multiple of 149 times. Not a surprise that these stocks have corrected hard. The projected earnings growth for the market for 2025 is about 13%. And even if you shave off a few points as a margin of safety, it is still above the long-term average earnings growth of 9%. So earnings growth remains robust and is the proverbial lifeblood of the market. Gains from artificial intelligence and technological advances are real and sustainable, driving earnings growth. We're not looking at an earnings stumble that pressured the markets in 2001, 2008, and 2020. It's just what investors are willing to pay for that good earnings growth for specific names that is up for debate. Finally, allow me to deliver some context to market volatility and corrections. I came into this business in 1987 and have experienced 6 bear markets. I wish I could say that it doesn't create a little less anxiety than it did in the early stages of my career in this industry. We are all human, and there is scientific research to show that we feel the pain from losses twice as much as the euphoria of success. But remember, history is on the side of the markets to succeed. In the last 99 years, going back to 1926, the markets have had up years 73 times and down years 26 times. The average returns in the up years have been 21.5%, and the average loss in the down years has been minus 13.4%. The key takeaway is that the markets are more up than down. Also consider that market declines over 10%, what we call a correction, happen about every 16 months, and declines of over 20%, what we call a bear market, happen every 5.5 years. So declines of this magnitude are not unheard of and a fact of life. As the saying goes, time in the markets, not market timing, is what drives success. Trying to time the markets by jumping into cash is probably one of the worst things you could do, because nobody can precisely call the tops and bottoms of the market. If you had invested $10,000 at the beginning of 1980 and stayed fully invested till the end of 2024, your money grew to about $1.7 million. If you missed the 10 best days in the markets, your money only grew to about $763,000. So, in effect, you threw away about $945,000 by being too smart for your own good. Everyone hates losing money, but research has shown that the odds of losing money are higher when you are invested in the markets short term, but shrink dramatically as your holding period increases. If your holding period is 3 months, you have a 30% chance of losing money. But if your holding period is 10 years, you have a less than 3% chance of losing money. Knowing your time horizon and having an appropriate asset allocation matters. In closing, let me say that the markets are more uncertainty, as we have seen recently in the short run. But in the long run, earnings growth and valuations have a greater influence. If done right, the tariffs as a tool for policy change mindset could have marked positive outcomes, such as reduced spending on drug and border controls. As always, patience is a virtue, and facts and reason triumph over irrational fears and sentiment. Thank you for listening.